Hello, everybody. Welcome to another David OS CPA production. I am Chad Denson, and today we're talking about tax smart charitable giving. We're going to talk about things like QCDs, appreciated stock, donor advised funds, charitable contribution bunching, donating stuff, and gifting appreciated assets to family. Why is all of this important? Why are we doing this video today? Well, with the big, beautiful tax bill having just passed, the new standard deductions are $15,750 for single filers. Head of household can expect to receive a standard deduction of $23,625, and married couples $31,500. So before we're able to itemize deductions and deduct charitable contributions, it means that all of our deductions like mortgage interest and medical expenses and property taxes and charitable contributions need to be greater than, all added up, the standard deduction of 15,750 single or 31,500 for married couples. So it's really difficult to come up with those numbers, which is why we're specifically having this conversation. So qualified charitable distributions are a phenomenal tool for some of our wiser clients. If you're age 70 and a half or older, you can donate up to $100,000 a year directly from your IRA to a qualified charity. So this is a great way to make contributions to your favorite charities because it specifically lowers your adjusted gross income without having to be considered in the itemized deduction calculation because it reduces AGI. It also can reduce, because it reduces AGI, it reduces Medicare premiums and the taxation of Social Security. So this can be a really phenomenal tool for, again, those of us who are a little wiser than some of the rest of us. Appreciated stock is another great one. If we give shares of long-term appreciated stock directly to a charity, we don't have to sell it ourselves, pay the tax on it, to then donate that cash. So we can donate appreciated stock directly to a charity, and then the charity can sell that stock. But because they are a nonprofit organization, they are not subject to paying tax on the sale of that stock. So that's a really phenomenal tool to be very tax efficient with a charitable contribution. Donor advised funds are another really great way to essentially lump a number of years of donations into a single year's tax deduction. It has to do a lot with timing, right? So with any kind of a charitable contribution, we can only deduct up to 60% of our adjusted gross income, the new tax bill, in the year of a contribution. With the donor advised fund, we can make a giant contribution in a single year, get a deduction for it in that year, and then continue to make grants to charities later on. It makes record keeping a lot easier. Donor advised funds can be a really neat vehicle to help you deduct your charitable contribution giving. Bunching, timing, right? So the standard deduction may be too high, especially in Southern Arizona with our flat tax rate of 2.5% and the low mortgage interest rates we enjoyed recently to be able to itemize deductions. However, if we were to bunch, say, 2 to 3 years of donations into a single year, we might have a really large contribution this year and then no giving in the next 2 years. And then 3 years from now, we might have another really large contribution. If we're scheduling it like that, then all of a sudden, we're going to have much larger itemized deductions to report as charitable contributions in a single year, which might help us itemize. I get this question a lot. And when we're donating stuff, right, when we're donating furniture or clothing or equipment, we have some record keeping things that we need to consider. So valuation guides are important if we're going to be donating a lot of various stuff like shirts or clothing, I suppose, or CDs or DVDs, those sorts of things. When we're donating larger things like furniture or computer equipment or art or things of this nature, we are not allowed to take any deduction for anything $5,000 or greater unless we have an appraisal. There's a very specific process to fill out. It's called an 8283 form to be able to deduct the stuff that we are donating to a charitable organization. So if you have those items that you'd really like to donate, but they tend to be more valuable, it's really important that we go through the proper channels and document the value of these items, no matter what they are, but specifically the larger items, so that we do qualify for those charitable contribution deductions. Again, with timing, if we're thinking about a Roth conversion, right? We've already talked about what a qualified charitable deduction is, and how we can donate directly out of an IRA or 401k. Well, if we were to do a conversion from a Roth IRA, excuse me, from a traditional account into a Roth account, so that they might not be subject, so the distributions from the Roth aren't subject to required minimum distributions, and they're not subject to income tax for either us or our beneficiaries in the future, then we could pair that conversion potentially with a QCD, which would potentially drop or reduce the amount of AGI and the taxable income to keep you out of specific tax brackets. So the strategic timing is also another tool to consider when donating to charity. Other appreciated assets we could consider giving to family, who could then turn around and sell them in lower tax brackets. So if we had a lot of stock, or a home or something, and we had a family member that needed money immediately, right? We could potentially gift a lot or a group of appreciated stock to a family member who may not have a capital gains tax rate at all, where we might be in a 15 or 20% tax rate. So it can be a really great strategy to transfer those assets to another family member to sell, so that they can capitalize and use those funds more urgently. This can be a really bad strategy for long-term transfer of assets, as a lot of the time some of these assets get what's called a step up in basis upon our death when we become a decedent, and your beneficiaries can actually sell these assets and not pay any tax on them, instead of paying them at their rates. So it's really important we do some strategic planning on gifting. So that is my low-hanging fruit for today's charitable contribution planning. Thank you so much for joining us. Key takeaways are that smart giving isn't just generous, but it should be strategic, right? Tools like QCDs, donor advised funds, and appreciated stock donations can lower your tax bill and amplify your legacy. Small behavioral shifts can lead to big tax savings. Chad Denson, David OSCPA, again, thank you so much for joining us. Have a great day.